The Simple Path to Wealth is a book by L.J. Collins about a simple and easy to manage roadmap towards building your financial freedom. Many people don't find investing and money in general interesting at all, so they don't want to spend too much time learning about it. This is the perfect book for them as it proves that investing can easily be made simple and making it more complex often actually gets you worse results instead. In this video, we'll go through the key ideas and takeaways from the book, but before we do, feel free to subscribe and ring the notification bell for more personal finance and investing related content and weekly book summaries. Takeaway number 1. The most powerful tool for navigating the world. Since money is the single most powerful tool we have for navigating this complex world we've created, understanding it is critical. In order to achieve financial independence, stop depending on others, including our employers, for income, and gain total freedom, it's necessary to understand how money works and how we can use it to generate streams of completely passive income. If you decide that you wish to pursue financial freedom, you're going to have to allocate a portion of your income, sometimes a significant portion of it, towards investments. Becoming financially independent often depends as much on your ability to control your needs as it depends on growing your asset column. Now, financial independence is not just about being able to retire early. It's also about having options to do what you want, say no whenever you feel like saying it, and having the freedom that it can offer. Having a few money, or enough money to be completely free of other people's demands and to be able to do exactly what you want when you want it, is one of the major steps towards financial independence, and everyone should have their FU money in this day and age. When you become financially independent, you don't have to stop working. Working becomes a choice. You can continue your career if you enjoy it, you can switch to a different one that offers lower income but is more fun or lets you help other people, or you can stop working for good. The freedom FI offers lets you choose to do what you want, not what others want you to do. Takeaway number 2. The most dangerous obstacle to building wealth. Debt is often the single most dangerous obstacle to building wealth. It lets people buy things that they really can't afford, and thus allows companies to actually sell their products and services at much higher prices, good for the companies but terrible for consumers. Debt today is accepted as a perfectly normal part of our lives, and the fact that there are readily available loans for many purposes brings the prices of those goods and services artificially up. Education, homes, and many extravagancies are very good examples, yet very few people see this as a problem. Most people can never buy their financial freedom simply because they are convinced that using debt as a ticket to quote-unquote the good life that they can actually not afford is perfectly normal. Using debt for luxuries only makes you pay interest for not delaying pleasure, ties you to a bigger stream of income, and builds up unnecessary stress. This is why you should avoid bad debt at all costs, and if you already have any, the author suggests you consider paying it off using this interest-based schedule. Less than 3%, pay it off slowly and invest some money instead. Between 3 and 5%, do whatever you feel comfortable doing. More than 5%, pay it off as soon as possible. Now here's a simple but not easy way to get rid of all your debts. Make a list of all your debts and rank them by interest rate. Pay the highest interest rate one first while keeping the minimum payments on the others. Eliminate non-essential spending to speed up the process and shift the money towards investments once all your debts are eliminated. Also, be careful when it comes to good debt. Make sure it's not too risky and that it's actually an investment, not just a luxury, like a primary residence, for example. Takeaway number 3. How to think about money. There are many things money can buy, but the most valuable of all is freedom. Level 1. It's not just about spending. You could spend your money, understanding only that money buys stuff. You could invest it and spend the returns, understanding what your money can earn. You could invest it and reinvest the returns also, understanding what your money and the money it earns can earn. Level 2. Consider opportunity costs. Every time you spend some money, you also pay the opportunity cost of the fact that that money can no longer work for you and make more money. So consider how much that money would make per year at, for example, 8% return plus compounding. Note that the cost keeps increasing forever as time flies by. Level 3. How to think about your investments. Events such as dips, crashes, and recessions are perfectly normal and you should expect them. Don't panic sell when they happen. Stay the course and invest even more during such events, as you can buy more stocks at a discount and wait for the markets to recover. You should look at your holdings for what they actually are, ownership in a company. If you are part owner of many good companies, why would you sell those companies at a discount during a sale? Nobody can accurately time both market drop point and the bottom, despite the fact that many claim that they can. If you can stomach the downturns and accept the fact that over a long investing period your portfolio might get cut in half multiple times over and it will recover eventually, investing will be a tough choice for you. Takeaway number 4. Why most people lose money in the market. First, a few facts. The market always goes up. It always recovers after a drop. It's the best performing asset class over time, and it's self-cleansing, meaning it clears out deadweight companies so new and more profitable ones can replace them. So, if we take all that into account, how and why do most people lose money in the market? Here is why. We think we can time the markets. In reality, trying to time the market makes us buy high and sell low. Interestingly enough, most investors in mutual funds get worse results from their funds than their funds actually generate. Why? Because most investors jump out and then jump back in at the wrong time. We think we can pick individual stocks. It's insanely difficult to even slightly beat the market average over the long term, and you won't see it consistently happen often. Only a handful of investors achieve this over the long term, and this made them practically legendary. So just pick the whole market index instead. We think we can pick winning mutual fund managers. In 2013, there were about 20% more mutual funds than publicly traded stocks in the US. During the 15-year period between 1998 and 2013, only 18% of actively managed funds managed to outperform the index. But it's obviously very hard to guess which ones are going to be able to repeat that, and all of them charge much higher fees than index funds. Another study looked at funds between 1976 and 2006, so a 30-year period, and out of 2076 funds, only 0.6% managed to beat the index. Ouch. The longer the term, the lower the likelihood of success, but the fees keep piling up. We focus on the foam. Imagine that somebody poured beer for you in a dark cup that you can't entirely see through. And they did it quickly, so you know there's gonna be some foam there, but you have no idea how much is the foam and how much is actual beer. It's as hard to know how much of a stock's current price is purely speculative. This is why the prices can change so fast and so drastically. Remember that the foam doesn't matter that much, you came for the beer. Takeaway number 5. Investing is not complicated. Before you even begin investing, there are 3 things that you should consider. How much risk is acceptable for you? Are you trying to accumulate or preserve wealth, or both? And is your investment horizon long or short term? There are only 3 tools that you will need for this simple investment approach. Stocks. VTSAX, Vanguard Total Stock Market Index Fund. Stocks are the core wealth building tool as well as a hedge against inflation. Bonds. VBTLX, Vanguard Total Bond Market Index Fund. Bonds generate some income, but mostly just smooth out the market ride and also serve as a deflation hedge. Cash. Cash is used to cover expenses and in cases of emergencies. It's also great in deflationary times. It doesn't generate income though, so keep some, but as little as possible in your bank account or in a money market account. By tuning the allocation between these 3, you can adjust the levels of risk and potential returns. Adding more stocks tends to provide better yields at higher risk, while adding bonds and cash will smooth out the ride at the cost of some returns. Bear in mind that using an index fund as your main tool doesn't make you lazy, it makes you a person that wants the best results. Picking stocks is way more likely to just lower your overall returns and take more time while you're at it. Consistently buying an index fund is the best way to ensure good returns, so make sure you don't keep putting in more effort for less returns. Additional note, invest within your 401k and/or IRA to reap any tax benefits that your plan may offer. If you're young, there are many years of investing ahead of you in your accumulation stage, and adding more risks by allocating more towards stocks is often a great choice as you have more time to make up for any dips. VTSAX offers great returns over the long term, the only problem is emotionally handling the drops. Holding 10 to 25% bonds and 75 to 90% stocks can sometimes outperform pure stocks though. If you've entered your wealth preservation stage, have already made the money and now you want to keep it safe while it continues to generate some returns, you should start adding bonds to your portfolio and rebalancing the portfolio every year. If you already have a fixed retirement date in mind, you should start shifting to bonds 5 to 10 years beforehand. In this case, you can also look at target retirement funds and use them instead. If they are too aggressive or too conservative for you, you can choose a date before your actual date for more safety and add more aggression by choosing a later date. Takeaway number 6. The 4% magic. If you've never heard of the 4% rule, it's based on a study of the outcomes that a portfolio would have had historically using different withdrawal rates. It includes over 50 years of data and keeps being updated. Using a 4% withdrawal rate, a 50-50 stock bond portfolio adjusted for inflation at the end of 30 years, 96% of the time remained intact or even gained in value. That's the case 100% of the time for a 70-25 stock bond portfolio. Actually, in most cases, you'll be fine with even higher withdrawal rates. This means that you can safely withdraw 4% each year with the chances of you running out of money over a 30-year period being negligible. If you choose to go even safer and withdraw 3% or even less with a 70-25 stock bond portfolio, it's basically impossible for you to run out of money during a period of 30 years. Your portfolio will almost certainly grow instead. You can also use a varying rate between 3 and 7% according to the market situation if you want. But pay close attention to what's going on with your portfolio if you're over 6% to make sure you don't overspend. To summarize, the most powerful tool for navigating the world. In order to achieve financial independence, stop depending on others for income and gain total freedom, it's necessary to understand how money works and how we can use it to generate streams of passive income. When you become financially independent, you don't have to stop working. Working becomes a choice. The most dangerous obstacle to building wealth. Debt is often the single most dangerous obstacle to building wealth. It lets people buy things that they can't really afford, which has become the new norm. Avoid it at all costs and pay off any debt that you currently carry. When it comes to good debt, make sure it's actually an investment, not just a luxury. How to think about money. You need to understand what your money and the money it earns can earn. Consider the opportunity cost and expect events such as dips, crashes, and recessions. Why most people lose money in the market? Well, because we think we can time the market, we think we can pick individual stocks, we think we can pick winning mutual fund managers, and we focus on the foam. Investing is not complicated. There are only 3 tools that you'll need for this simple investment approach: stocks, bonds, and cash. Consistently buying an index fund is the best way to ensure good returns, so make sure you don't keep putting in more efforts for less returns. The 4% magic. You can safely withdraw 4% each year with the chances of you running out of money over a 30-year period being negligible. If you choose to go with 3% or even less with a 70-25 stock bond portfolio, it's basically impossible for you to run out of money during a period of 30 years. Your portfolio will almost certainly grow instead. Thank you for watching, and I really hope this video was useful to you. As a final note, let me just clarify that this is a summary of a book. It's not investment advice. You should always do your own due diligence before investing, as it's your money and you and only you are responsible for the consequences of your own actions. With that out of the way, there's one new book summary out every week, and much more investing and motivation related content is on the way, so feel free to subscribe for more content, ring the notification bell, leave a like on the video so more people can actually see it, and share it with a friend if you think it will help them. I'll see you next week, so enjoy the rest of your day. Bye bye!